On tapering, even in the face of the Omicron variant.
Now the economy is strong, and it's strong, and inflationary pressures are high. So we're looking at going to discuss the possibility of a faster conclusion and wrap up those purchases a little earlier.
Crude prices rebound after a sharp sell-off on Tuesday's session as OPEC and its allies prepare to begin 2 days of talks over their output strategy. UBS names Sarah Youngwood as its new CFO, replacing incumbent Kurt Gardner in the latest shake-up at the Swiss lender. Chinese November factory activity sinks back into contraction territory amid weaker demand and soaring prices.
So there's a lot to say about yesterday's session, but safe to say that if you were long the market, you got it from both sides. You thought you had the central banks with your back covered if indeed Omicron were to be as proliferating and as concerning as many people fear it is. But Jay Powell put a bit of a question mark over that yesterday by various of his comments, but safe to say it was a comment about the swifter taper and perhaps retiring the word transitory, which were two of the more interesting parts in the first part of his two-day testimony. And of course, Omicron concerns are continuing as well, whilst the scientists just work out how serious this variant is. So the market got it from both sides yesterday. And actually, I was looking for the rally throughout the session for the Dow, and it didn't happen. In fact, if anything, we got worse into the close. We're down 652 points on the Dow. The Nasdaq, I'm sure you're aware, didn't close unchanged. It closed actually 1.6% easier. That was down 245 points, which is now 4.2% off its record. I will reiterate that those amazing stats from our stats team, who basically just talking about the components of the S&P. In fact, if I stand in front of the Nasdaq, it doesn't happen. It's not there. So the fact is, although the S&P itself is below its record high by about 3.7%, there are vast swathes of stocks who are really in either correction or bear market territory. For instance, 258 stocks are more than 10% off their 52-week highs. That means they're in correction territory. 120 stocks, just under a quarter of the S&P, are in bear market territory, down over 20%. So it's very interesting. If you have some form of ETF or tracker or futures instrument that monitors that, you are down a handful of percent. But if you are looking at the broader market and you have some of those constituents, you are getting an absolute drubbing. So two very different experiences, of course, of what is going on in the S&P and broader America. And I think that's fascinating and just shows you, doesn't it, really? I'll just say one more time, just shows you the concentration of those big 4 or 5 mostly tech names as well, and how that skews the broader picture in the SP 500. I think that's absolutely fascinating. Let us move on to the treasuries. Again, Jeff was talking about what was going on here as well, but we're still in kind of the crisis mode, going into safe haven territory on the 10-year at 147, bearing in mind at the start of last week, we were knocking on the door of a 1.6 handle as well. So concerns about Omicron certainly has made people think, well, actually, A, we want to be in treasuries, and B, maybe, despite what Jay Powell said yesterday, the Federal Reserve won't be that aggressive. I will give you a little bit of information about what is going on in the session today. We have mortgage applications, the ADP employment report, manufacturing PMIs out of the States, ISM data on the manufacturing front, and as I mentioned as well, plus the Beige Book, of course, and Jay Powell continues his testimony, this time in front of the House. Let's have a look at the Asian indices. A rally for the Hang Seng, a rally for the Nikkei. Those two got it quite tough yesterday. The Shanghai Composite and the ASX 200 are bearing nowhere near as volatile as those former two in this current move as well. I'll tell you what's also volatile is Brent and WTI, especially WTI, because yesterday we saw the WTI contract below $67 a barrel, which basically took it into bear market territory. There's a lot of bull case scenarios, and I'm reading them all, about why the oil price could go higher from here, why it's going back up to $80, why it's going to 100, 120, according to some. But the fact of the matter is, at mid-afternoon yesterday, WTI was in bear market territory, having come down from 84 to $67. on the front month most traded contract. In fact, it was trading at 64.73 at its lows yesterday. But a big rally going on in WTI, a more moderate rally going on the February contract now on Brent. Opening calls for European markets. It's looking positive if you are long the market. 71.29 the FTSE. Elsewhere, big rally called on the CAC 500 and 71 points. Should we have a look at the US futures? Let's do that. Okay, so US futures, very nice, yes. 224 higher for the Dow. NASDAQ 265 higher, which is amazing because apparently it was unchanged yesterday. No, it wasn't. It was down. 265 points higher, and the S&P up 48 points at the start of trading.
Let's check in on the latest on Omicron. U.S. Chief Medical Advisor Dr. Anthony Fauci says it's too early to tell whether the new variant will lead to severe disease. He said preliminary information from South Africa suggests the variant doesn't result in unusual symptoms. The new strain of the virus has so far not been detected in the US, but officials there, along with President Biden, are urging people to get their vaccines and booster shots. The COVID vaccine developed by BioNTech and Pfizer will likely offer strong protection against the new variant, so says BioNTech's chief executive, Yuga Sahin, who told the Wall Street Journal that it was important, quote, not to freak out and let countries speed up the delivery of booster jabs. Sahin added the company was already working on an updated version of its original COVID vaccine. Germany's next chancellor, Olaf Scholz, is in favor of mandatory vaccinations for everyone as the country grapples with the latest spike in cases. He expressed his support during a meeting with outgoing Chancellor Angela Merkel and state leaders as they gathered to talk about the latest measures. A decision on whether to make vaccines compulsory could come as early as Thursday, with the mandate coming into force early next year. Germany recorded over 45,000 new cases in the past 24 hours.
The chairman of Siemens and Maersk, Jim Hagman Snabe, actually, we speak to him a lot when he was at SAP, didn't we? Co-CEO there. He, anyway, spoke to Annetta and said the world was getting COVID fatigue.
There's no doubt that yet another wave is not what we needed, not just because it's Christmas and we need to come together, but because we're getting tired of COVID. So there's no doubt that it is concerning. At the same time, I must say that at least the businesses that I'm involved in, they have learned to deal with a corona. We run the companies, in a digital way. We can make the necessary decisions. We can execute. Both Maersk and Siemens are having record years in 21, which indicates that we can deal with this. So my concern is mostly the restaurants, the airlines, the hotels. So a very particular industries where it's of course an issue if you can't move around. But other than that, I think we have learned to deal with it. So it's concerning from a health point of view. It's concerning because we don't know when this will end. I personally believe we'll see more waves. And I am very much arguing that we need to get our vaccinations. It is the only way to stop coming back to this closing down countries.
UK Prime Minister Boris Johnson said the government will ramp up delivery of booster shots in response to the new variant. In a televised briefing, Mr. Johnson said vaccines will be administered in over 1,500 pharmacy sites and centres around the country, adding that temporary vaccination sites will start, quote, popping up like Christmas trees.
The target that we've set ourselves is to offer a booster to everyone eligible by the end of January. And as with the first jabs, we'll be working through people by age group going down in 5-year bands, because it's vital that the older and the more clinically vulnerable get that added protection first. We're going to be throwing everything at it in order to ensure that everyone eligible is offered that booster in, as I say, just over 2 months.
Boris Johnson. Well, France has recorded more than 47,000 new coronavirus cases over the past 24 hours, the highest daily rise since April during the height of the third wave. The number of patients in hospital has also increased to more than 10,000 for the first time since September. French authorities say the vast majority of hospitalized patients are unvaccinated. And Charlotte, it is worrying that we are seeing also, I think, more patients in intensive care?
Yes, absolutely. And that's what they're watching very closely. The authorities educate the cases up 60% on average over the past 7 days. You had the government talking, you remember last week, of this fifth wave starting at lightning speed. And this seems to be confirmed by the numbers. Of course, the eyes are on hospitalization. As you say, they're past that 10,000 mark. That is very symbolic of people in hospital with COVID. So it's up 20% over the past 7 days. And in ICU, they're up 25% over the past 7 days. So the authorities are watching very closely. And that's in the population that is 88% fully vaccinated for all the over 12-year-olds. And of course, remember that France has started their booster rollout on a Saturday. Everybody above 18-year-old is eligible for a third dose 5 months after they had the second dose. And so this is crucial even more than ever now to tackle this wave. And they hope this will be enough to tackle it. Of course, the Omicron variant is throwing a bit of uncertainty in the context. Remember, France has a health pass already in place showing your vaccination status before entering public spaces. They also put mandatory masks indoors again since this week. But of course, with this Omicron variant, there's a lot of uncertainty. But the authorities saying, look, more than ever, it is important to get your third booster, no matter what. This will give you some protection, even though in the next few days we'll know how much protection this gives you. And on this topic of the vaccines, I had a chance to catch up speaking at the Conférence de Paris yesterday, the president of the Rockefeller Foundation, Dr. Rajiv Shah. We talked about the vaccine and we talked about this Omicron variant at the moment, and how in a sense it kind of shows some of the failure that we've had when we had some rich countries doing third doses. Some of the poorer countries have not even vaccinated and given their first dose to a lot of their population. And Dr. Shah was talking about how this is crucial that we start tackling this now, because no one will be safe until everybody is safe, and how the public and private cooperation and partnership is crucial in doing so. Take a listen.
We set two targets for much of the rest of the world outside of wealthy nations. One was to achieve 40% immunization coverage by the end of this year, and the other was to achieve 70% and therefore herd immunity by September of next year. Neither of those are going to be achieved through current efforts. And that's exactly why we have this dangerous new variant disrupting global markets and global economies and lives around the world. And, you know, our Rockefeller experts have estimated that new variants are 6 to 8 times more likely to come from lesser developed countries, because that's where viral replication continues to occur at a very, very high rate, because immunization has been so slow. And I frankly wish the companies that are involved here, Pfizer, Moderna, and others, would do more to make their products available either through partnership with local manufacturers or through true tiered pricing arrangements that could allow developing countries to access those products in the right terms much faster.
That was Dr. Rajiv Shah, the president of the Rockefeller Foundation. They've been involved with public health for a long time, since the very beginning, more a century ago. Their first grant was to the Red Cross. They've helped develop the yellow fever vaccine, and now they've been very much involved with the COVID-19 fight there. And again, this call to public company and some of these vaccine makers saying they need to do more to help tackle some of the vaccination in some of the poorer countries, because we will see more dangerous variants if we don't get to vaccine more people in those poorer countries. So a message out there for all these guys.
Well, Charlotte, hang around, because you've highlighted the next story, which is the far-right television pundit Eric Zemmour has officially launched his campaign for the French presidency. Now, Zemmour said he wants to, quote, save France in a video posted online, which was quickly blacklisted by French media outlets. Following reports, it features film clips without permission. Zemmour, who has twice been convicted for inciting racial hatred, has seen his campaign stumble out of the starting blocks after being photographed making an offensive hand gesture at a member of the public last week. I saw this hand gesture, actually, Charlotte. It didn't involve two fingers, is all I can say. Charlotte joins us now again with this. Charlotte, is he going to take votes off Macron, or will Macron be rubbing his hands with glee because of who he looks like he potentially would take votes off?
Well, that's really the question, where the votes will come from for him. Look, he kept the suspense going for a while. Will he run? Won't he run? There was a little that he would do. And then he announced yesterday in this 10-minute video posted on social media. And as you said, talking about how he wants to save France, talking about the glorious past of France, showing Napoleon to Bardot, and talking about the current decline of France. That's really been the topic at the center of his campaign, or pre-campaign, and that campaign is really talking about this decline of France. In a position, you see him at a desk reading a letter with a mic in front of him. That's an image that very much echoes a picture of the General de Gaulle when he was in London calling for resistance. So that will echo to other people. And he said he did that on purpose, of course, to this message to the French population, how he can save France as well. But look, it's talking a lot about immigration, how this is the cause of the problem, talking about the elites, all these typical populist subjects that he's exploring there in that video, accusing the European technocrats, the academics, the judges, etc., in that video. And again, he had a bit of a buzz at the beginning of whether he was going to run a few weeks ago. He went ahead of Marine Le Pen, the other far-right candidate. Now he seems to have a little bit of stumbling block. He's doing less well in the poll. He's still in third or fourth position, potentially in votes in the first round. But it seems that Marine Le Pen, he's gathering speed ahead of him again. Now, the question is where he's taking votes from. Is it from Marine Le Pen, or is it from the center-right party as well, Les Républicains, that are also in their run to pick their own candidate? They had their last debate last night, Les Républicains, on the candidates running. We will know on Saturday which of these candidates will be the official candidate in the election. And then that means that by the end of the week, we will have all the names of everybody running in the election, apart from one. Emmanuel Macron hasn't announced just yet that he's running. Usually for the president sitting, it takes a little bit longer to announce that he's running. Usually other presidents have done it just about a couple of months before the actual election. And we know that he's aligning all his troops really to prepare the election. But for Éric Zemmour, look, the tough fight really starts now for him, because one thing is being a bit controversial, a bit of a someone making a fuss in the media. Another one is being an official candidate, and now he needs to get some money, which is very difficult, getting the finance to run his election. Also, he doesn't have a party. He likes to show himself as a bit of a Trump, and he can be a disruptor like this, but he doesn't have an official party behind him. He doesn't have an electoral machine to win this election. That's a big difference there. There's only one person that managed to win an election without a big electoral machine behind him. It was Emmanuel Macron. But look, he was still an insider in politics. He was running in ministries. He was in touch with the whole system. It's not the case for Éric Zemmour. So things could be difficult for him. And again, one final hurdle is you need to get 500 signatures of elected people, whether it's mayors, MPs, etc., to be allowed to run in the election. And you have to present these 500 signatures. It's still unclear whether Éric Zemmour can have all those signatures to actually present himself to the election. So there's a lot of unknown there. But one thing we will know at the end of this week is who is actually running. We will have all the final names of all the main candidates for all the people that try to compete with Emmanuel Macron in the election coming in April. Guys.
Terrific. Charlotte, thank you so much for that. Still to come on the programme, Salesforce missing fourth quarter guidance, sending shares sharply lower after hours. We have details when we come back.
Good morning, everyone. As usual, we trade gold first hour in London. Our target every month like 15,000. Last 3 months we did about 34,000. This month we didn't do anything yet. I'm just waiting for the right setup. I recommend if you are first time to see us, just watch for a week or two, see how we trade. Then you can join us on the chat room later if you like what you see. So we usually trade the London gold for first 15 30 minutes. Then we move to Forex market. So far in the Forex market, like OCN is good, Euro Yen is good, Pound Yen is good. So the risk is on. When the risk is on, people like to go long OCN, Euro Yen, Pound Yen, CAD Yen. This means the market is very good. The traders, they don't worry about anything, about Corona, about earning or anything. This is a good sign. That's why the Nasdaq is going been higher. Now, if the Japanese yen green and everything else is red, this means the market in really, really trouble. Like last few days when we sold out for, let me show you. Like on Friday when everything was off, the market sold off hard, the Japanese yen was green. Like when we sold hard here, was green and everything was red. So just be patient, and we will wait for the right setup on gold. And you can see my trade lines.
Because we kept being told that COVID, if anything, has accelerated companies moving their services to online platforms or the cloud. But maybe expectations have just been too high.
I think that's right. I think expectations were enormously high for double-digit, high-margin growth going forward. The problem is a lot of players are doing this, and as such, double-digit may still be there, and I have no doubt that the growth will continue. But it's, again, like all technology since the dawn of time, when you have a lot of players doing it and the technology becomes more widespread, then your margin gets crushed over time as well. The other thing I'm interested in, whether it's demand or supply-led weakness as well, i.e. are they struggling to put the services out there because of a variety of reasons, or actually, as we're alluding to, is actually the businesses themselves just saying, well, we don't need to move at quite the pace that you're telling us we need to move at.
Yeah, well, let's get some more insight. Salesforce, also disappointing. The California-based company turned in better than expected earnings and revenue for the period ending October 31st. Shares dropping more than 6% in after-hours trading after the software giant's fourth quarter earnings guidance came in below expectations. Julia Borstein has more.
Salesforce announcing that President and COO Brett Taylor is promoted to co-CEO along with Mark Benioff. Taylor also becomes vice chair of Salesforce's board. Now, the company beat expectations in the top and bottom line, but it was the company's guidance that fell short of expectations and sent Salesforce shares lower in after-hours trading. Revenues of $6.86 billion were just ahead of the $6.8 billion expected, while adjusted earnings of $1.27 surpassed estimates of 92 cents per share. But guidance for fourth quarter earnings of 72 to 73 cents fell far short of the 81 cents that analysts anticipated. And the company gave a longer term outlook, guiding to revenue of $31.7 to $31.8 billion. That's below the $31.8 billion that is the analyst consensus. Co-CEO Mark Benioff kicking off today's earnings call, talking about his new partner, Brett Taylor, saying he's had an amazing run over the past 5 years that he's been at the company. Taylor adding that this partnership is the culmination of what he called a decade-long friendship. Benioff also talked about how each of the company's cloud divisions are growing by double digits, and he talked about why they are raising their guidance. Julia Borstein, CNBC Business News, Los Angeles.
Before we get to the next story, before we have a chat, just two quick questions. Did you and your family buy a load of stuff over the Thanksgiving weekend? Obviously, we don't celebrate Thanksgiving, but did you buy stuff with Black Friday and what have you?
I think we may have done.
Yeah, we bought a bit of stuff. Yeah. I mean, let's just call it stuff.
Well, the packages have not stopped arriving, I think it's pretty clear.
Exactly. Okay. Yeah. And did you buy a lot of it on buy now, pay later?
No.
Did you buy any of it at Buy Now, Pay Later?
No.
Oh, okay, I'll come back to this. Because the PayPal CEO, Dan Schulman, says the use of the company's Buy Now, Pay Later option surged on Black Friday. He told CNBC that the installment service has proven to be one of the company's main drivers this holiday season.
During Black Friday, our volume on Buy Now, Pay Later was up almost 400% year over year. We did some 750,000 transactions alone in one day on Black Friday, in one day. And Jim, in November, it was our first time ever that we did over $1 billion of processed volume on Buy Now, Pay Later in a month.
So the reason I asked you, because I think you're a metaphor, I'm a metaphor. We bought a lot of stuff, Mrs. S, but we didn't use Buy Now, Pay Later, whether it's Klarna, PayPal, whatever. It's not what we do. But others did. And I'm very interested in why. Because the US savings rate, albeit off those dramatic highs we saw throughout COVID, is still stunningly high. To buy off the back of an envelope calculation is about 50% higher than it was before COVID. For instance, in December 2017, we were around about 6 handle on, give or take, on the month, 6 handle, 6.6 on what US savings rate was. The latest savings rate data I have out of the United States is 9.4%, which is a huge deceleration from the previous figure. So here's my point. If we have people who are saving at 50% higher rate on average in the United States than they were before the pandemic, why are people using more Buy Now, Pay Later as well when they've got the extra cash available on their household balance sheet? And I would suggest it's not the same people.
No, I'll take that argument on board, but I will say for some people it works because it's a neat way of juggling balances, because some of these Buy Now, Pay Later services actually give you an interest-free period.
Yes, they do.
A bit like credit cards, where
Yes,
you
they
have
do.
the opportunity, just if you're getting a little tight to the end of the month, you can pay using that system, and then ultimately you
It's
can
still
cover it
forward
off
spending.
before you pay the interest.
Still forward spending for something that you wouldn't otherwise be able to afford.
Yeah, but it might go up in price next month, and you can get a bargain now.
What, because we're retiring the word transitory?
Perhaps.
Perhaps we are.
Perhaps.
See, we tied two stories together. Coming up on the show, it's what we do. A word we've heard a lot this year. Could be on the way out. Oh, wow, it's here as well. Look, the T word, transitory. Jay Powell says maybe time to retire it. We'll discuss.
Just to let you know, guys, I took a Nasdaq short on the Forex account. On gold trade, I didn't take anything yet. This month, we're still flat. Now, we said a few days ago about euro dollar, and always rally for 200 points. We talk about it on Friday, Thursday here, and I have my line right here. And you can see we went from 112.20 to 113.20 to 113.75. So it's 175 pips in 3 days. Now, the holiday is over, so the market back to normal. But the big drop here when the Fed was speaking today around 9 o'clock, 10 o'clock.
Welcome to the second hour of Squawk Box in our headline.
He said something, so the market dropped and back again. So if your long-term view, even if you get big sell-off, because maybe news or something, here you go. You can listen what he said.
A sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation.
Crude prices rebound after a sharp sell-off in Tuesday's session as OPEC and its...
So if your long-term view is higher, you maybe get a news, non-farm payroll, any kind of news, you market sell-off and you go back to the normal. So, but you have to deal with something like that. And we did a video last week. I did show you how you deal with situation like that. If you are long and you get big spike down or up, what do? You need to have the knowledge to come back and you put your account in the right way. So right now I'm still looking for setup for gold.
Let's get straight into the market story then. US markets tumbled overnight after Fed Chair Jerome Powell struck an unexpectedly hawkish tone, saying the central bank would discuss speeding up the pace of tapering at its December meeting in order to tame rising inflation. His comments came as the Omicron variant continues to spread, but so far, no cases in the United States. Speaking before a Senate panel, Powell said tapering could wrap up sooner than previously anticipated, opening the door to interest rate hikes soon after.
At this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. And I expect that we will discuss that at our upcoming meeting in a couple of weeks.
Right, well, it's been quite a debate, hasn't it? The word transitory. Mr. Powell also declared it's high time to retire the word transitory, a key term the Federal Reserve has used to describe recent price pressures.
The word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
In addition to the inflation picture, Powell also told the Senate that the Omicron variant poses risks to the economy.
The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risks to the employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions.
We've got the US markets here from yesterday and decent sized declines. And let's just have a very brief chat about this. I doubt we'll do it as well as we did at the top of the 6 hour when we were fresh, Jeff. But the point here is, the market has had an assumption that the Fed has got their back throughout COVID, and the Fed has got their back still to an extraordinary level of support, both in quantitative easing and indeed in level of interest rates as well. But the fact of the matter is, what Jay Powell did yesterday, despite the unknowns about Omicron, he said, look, we are still moving ahead potentially with a slightly more hawkish tweak. We may well get rid of this accommodation in quantitative easing quicker, i.e. if it was going to finish in June, maybe now it's going to finish in the spring as well. And the market wasn't prepared for that. I think they wanted soothing mood music as we wonder what's going to happen next on Omicron. And that's why the market went 1.9% lower yesterday, because instead of having the support over here and indeed the Omicron concerns over here, earlier, what they got was actually support moving to the other side as well. And there was nothing to counterweight it as well. And you certainly weren't going to get a counterweight from valuations as well. So very, very interesting that these counterbalances, the scale, so to speak, moves significantly over to one side. And that's why the Dow finished on its lows. The good news is if you're along the market is you are going to get some respite at the start of trading. We're getting respite in the European futures and the US futures as well. So let's have a very quick look at where the US futures are currently trading. But one thing I will note, this isn't that stunning a rally just yet. This is only, just over a quarter of the declines we saw yesterday. And the other point I'm going to make, and I've made it a couple of times in this show, but I think if you haven't been watching the whole show, A, shame on you, and B, the S&P is only 3.94% away from its record high. So if you are exposed via a future or an ETF or some form of tracker, then that's fine. But if you are looking at your individual components, there are stunning numbers of companies, i.e. just over half, who are in correction territory, which is over 10% lower. There are large numbers, around about a quarter, of S&P components who are in bear market territory, down over 20%. Twitter is down 46% from its 52-week high. Carnival, United Airlines down 45 and 35% respectively. Walt Disney is down 29%. You've got to remember, Walt Disney is one of those ones that, yes, the theme parks was tough. Yes, production was tough, but they've got Disney Plus. That's one of the winning sides of the trade from COVID, of course. Match Group down 28%. Clorox down 28% from the 52-week highs. And even MasterCard, 22% lower. So, yes, the S&P on a broad basis has done rather well if you're weathering the storm. But my goodness me, there's lots of stocks either in correction or bear market already. Yesterday as well, in the oil complex as well, we saw WTI dipping into bear market territory. There is a brilliant bull case out there. I've seen it, I've read it, I've looked at it, I've looked at the adjustments from Morgan Stanley, JP Morgan, Goldman's and others as well. But the fact is, at one point, mid-afternoon London time yesterday, WTI went into bear market territory. It's significantly higher than that now, by the way. But at $68, it's just avoiding down 20% from its recent highs.
I mean, I think as you look at those numbers, it's very clear that Jay Powell owns the sell-off. It was ultimately about him switching his language. I think one of the comments was he jumped lanes on our expectation as to what was going to happen with tapering policy going forward here. And I think the point here is that he has left an open window at this stage around what he thinks is happening with the economy, and we don't have clarity. You heard him say in that soundbite, well, transitory may not be the right word, we should retire that, but he didn't actually jump in and fill the void and say transitory for longer, or this is temporary but could become more permanent. There wasn't another assemblage of words that gave us a more detailed understanding. And I think partly that is because Jay Powell doesn't know. And obviously we're waiting to see the trajectory of inflationary trends, but we're also waiting to find out what Omicron actually means for anybody at this point.
It was very clever timing as well. You think about it, the market was down 652 points, but it wasn't a rout, it wasn't a crash as well. So now he's already got those comments out there. The market is now thinking, oh, hang on a second, we could have faster taper. And it's only cost him a couple of percent as well. What is the big danger here? That the market has a melt up because he gets his communication wrong, or market has a meltdown because he gets his communication wrong. And clearly, there's only one scenario that the market and he and broad economy is particularly worried about, and that is the meltdown. So I think by getting this communication in and it only costing 652 points, I think that's rather smart timing.
Yeah, look at the durability of the rebound that we're going to get, though. I think because we've known that buying on the dip has worked for you in past scenarios.
Every scenario in the last year.
Absolutely. So the question is, are we going to have a dead cat bounce, or is there something more sustainable here? And let's just reflect on how some other asset classes have performed here, because I think that may be a little bit instructive when it comes to thinking about where some of the big fish are parking their cash at the moment. And we did ultimately have a rebound in Treasury prices and yields lower, and this flattening of the curve. And the shorthand effectively is the market was drawing conclusions about the willingness of the economy, or the ability of the economy to withstand the twin pressures of Omicron and, of course, faster tapering at this stage. Let's have a look at the safe havens. Traditional safe havens, of course, on a day like that, gold, attracting something of a bid, but perhaps not as much as many would have thought. The dollar has been strong, and there is support for the dollar. The Swiss franc is also at multi-year highs at the moment, as the SNB doesn't seem to be too keen at this point to intervene to hold the currency down. In terms of equity safe havens, very hot discussion as to what kind of companies give you protection in an environment where you have a reduction in social contacts and an ability to socialize, to travel, and so on, all the things that working from home and lockdowns implies. Apple has shown resilience through COVID so far. It's managed to increase sales through the online channel. It provides a dividend, and many argue it gives you a certain inflation hedge as well. So it's one of those companies that benefited yesterday in spite of some of the sell-off that Steve was describing. The VIX notched up its biggest monthly surge since February 2020. But despite the heightened market volatility, billionaire hedge fund investor Ray Dalio says it is not safe to keep your money in cash.
To say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say, when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. Or when you see other markets, gold, you're seeing. Watch the market action on every day, and you could see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return. And you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets.
Some would argue that you have a generous or more sympathetic view to China than perhaps some of the most hawks, if you will, about China. But you think that there's sort of an inevitability to the transfer of wealth of sorts.
Well, okay, two things. China, transfer of wealth. I just know China very well, and I come as a perspective, with a perspective as an investor. I've been going there since 1984. I know leaders, and I know how they're thinking, and I know the moves that they're making in a detailed way. And I'm just trying to share what that perspective is, because I think a lot of people make stereotypical moves, and I think you have to really understand. First thing you have to understand, because it has been a remarkably successful place. Since I started going there in 1984, per capita has increased by 26 times and so on. So to not understand it or to approach it with a great bias is a great disservice. Okay, in terms of the element of, let's say, a transfer of wealth, or let's call it common prosperity. Yes, there's a world, in this world right now, there's a move to common prosperity. I think that that move, what does it mean at a technical level? That's not take your money away. But here, I would say what are called progressives here are much more left than what we would call progressives or whatever the Chinese policies are doing. But yes, worldwide, there has to be common prosperity, or let's call it broad prosperity. And the question is whether that's going to come about by productivity or not. It doesn't mean that you're going to have like a communism that's going to take all of that. There's going to be a lot of productivity in China. And so, again, diversifying the portfolio. You look at the United States elsewhere, you have to diversify.
Always fascinating listening to Ray Dalio. There's some comments out from Sajid Javid, who is the UK Health Secretary. He says we now have 22 confirmed cases of Omicron and that will go up, adding there is no need to change Christmas plans. Maybe in 2 weeks we'll know more about the Omicron variant. It is likely that vaccines will remain effective against serious disease from the Omicron variant as well. So very interesting there. And I know actually my copy on Reuters have changed to Omicron and Omicron as well. Everyone's struggling with this word, aren't they?
Yeah, I think so. Let's bring in Bob Parker. Bob is investment committee member at Quilvest Wealth Management. Bob, can we go straight in on what happened in the market session yesterday and whether Jay Powell has sent a very clear signal about a faster pace of tapering?
Absolutely. And I think the key point is the guidance from the Federal Reserve has changed. And, whereas previously guidance was that the tapering of the quantitative easing program would end in June or July next year, and the reduction in asset purchases would be 15 billion per month. I think you've got a very clear message, which is that given the inflation outlook, and they've dropped this word, which you and I have discussed in the past, transitory, which I think we all agreed was a very unsatisfactory way of looking at the inflation outlook in the States and other countries for that matter. So now we have guidance that the quantitative easing program will end probably in March or April. Is that guidance justified? I think the answer to that is absolutely clearly yes. Let's not forget that if you look at the rebounding growth in the fourth quarter of this year, the Atlanta Fed model is showing annualized growth in the fourth quarter of 8.6%. The consensus for US growth next year is 4%. I think that's right. But coming back to the inflation numbers, the inflation numbers are very elevated with CPI at 6%, the PPI numbers much higher. And I think it's fairly clear that inflation as we go into the first quarter of next year is probably going to stay at current levels. And what Powell and the rest of the Fed, I think, are very concerned about is they really want to try and control inflationary expectations. And what they don't want to be in a situation of is where inflation is still 6% this time next year. And I think they could tolerate if inflation comes down to, let's say, 3% in the second quarter of next year. But that obviously, as we talk, is a challenge.
Well, briefly, Bob, then, how do you trim your current portfolio of assets to make it more appropriate to this faster pace?
Well, I think that the first point to make is that probably the trend in bond yields, we've seen a small increase in bond yields over the last 24 hours. My view is unchanged, which is that the trend in bond yields in the United States is upwards, but that trend is probably going to be a slow increase in bond yields. Therefore, I think you have to be concerned about, areas which are sensitive to rising bond yields. And obviously, there is a quite good inverse correlation between the tech sector and bond yields. I think, the other point is that we've seen yet again over the last month the outperformance of the S&P versus Europe and also to some extent versus Asia. I do think that as we go into year end and the beginning of next year, you're probably going to see a rotation out of that expensive US market with a price earnings ratio still above 20 into what we call laggard markets in Europe and also Asia. And one of the big features of 2021 has been the underperformance of Asia. I think that's about to reverse.
Bob, lovely to see you as ever, my friend. Look, there are a vast number of stocks, and I've only realised just how many after we had some brilliant data from our team in-house. Yes, they put it together. How many stocks are in bear market territory or in correction territory in the SP 500? So whilst I take on board your comments about the relative valuation at an index level, at a broader level, how do we play the opportunity from stunningly lower stocks in the United States? And I'll just reiterate the numbers in case our viewers haven't been listening. 258 stocks are in correction territory in the S&P 500, and 120 of those are in bear market territory. Is there a way to play those stocks, or despite those declines, are they still overvalued?
Well, clearly, part of the sell-off has been in the tech sector, as we discussed, with the correlation with bond yields. I think that sell-off probably is overextended. So, I don't think we're going to, sell off considerably further there. The other areas where we've seen sell-off is obviously areas which are sensitive to COVID, and whether we like it or not, investors in the last 2 to 3 days have been reducing risk. Given their concerns about Omicron, given their concerns about increased case numbers, particularly in countries like Germany and Austria. And the investors are saying, well, perhaps we're going to have more restrictions on hospitality, more restrictions on travel. And frankly, that's already happening. And therefore, you've seen the hospitality, leisure and travel sector sell off. Now, if you buy the argument, or if your central case is that Omicron is going to be temporary, and that, the impact on hospitalizations from Omicron is going to be minor, then those sectors are going to rebound. So, the companies which you have been mentioning on this show, which have sold off very hard, if the question is, are they going to sell off incredibly further? I think the answer to that is probably not. And we've seen this sort of knee-jerk reaction and I can understand that reaction over the last 48 hours or so.
Bob, I don't know if you caught what Ray Dalio was saying, but Jeff and I always hang on to his every word. We're absolutely fascinated. And he's dived in once again into the China argument as well. And I'll just reiterate, he knows China very, very well, he says. He's been an investor there and going there since 1984. You, Bob, have been to China more than most people I've ever met as well. How do we play China if our viewers are interested in that?
Well, I think that is actually a fascinating question. The Chinese market, along with a number of other Asian markets, have underperformed significantly relative to Europe and the US markets this year. I think there are quite good grounds for saying that the Chinese markets are forming a base. And the reason why I say that is I think a lot of the negative factors are now fully discounted in the market. So, if we look at the problems in the real estate market, they're very well documented. I think the Chinese authorities actually have managed to sort of neutralize the impact of the problems in the real estate market. So I think that that negative factor is discounted and probably is largely behind us. I think the problems we had earlier in the year with regulation of the tech sector, a number of other sectors like social media, I think that sort of regulatory move against those sectors probably is now being moderated somewhat. And I think critically, in contrast to what we've been talking about with Jay Powell and the Fed, the People's Bank of China is doing exactly the opposite in response to the slowdown in the Chinese economy. And you referred earlier in the program to the manufacturing PMI, coming out today, less than 50 again. I think People's Bank of China are concerned about the slowdown in the economy. If they can hold growth at 5% plus this quarter and in the first half of next year, I think that that's very much what they want to try and do. So we've got monetary easing, bad news discounted. The market's become really quite cheap. As a consequence, I think you'll see investment flows, which were obviously negative for the Chinese markets for most of this year, start to move back in. So I know there's a big debate about, is China investable? I'm very much on the same page as Ray Dalio there, which I think the answer is yes.
Lovely to get your perspective as ever, Bob. Thank you very much indeed for joining us. Bob Parker, Investment Committee member at Quilvest Wealth Management. Well, we're talking about China there, and the Chinese manufacturing taking a hit as demand slows and prices pop. We'll have a little bit of a discussion about this. And if you missed our debates over Fed Chair Jerome Powell's decision to, well, he hasn't tried the word transit, say maybe we should. You can head to the Squawk Box podcast. I'm here, they're getting it ready for the next Pulitzer Awards.
So I just want to give you an update on Forex market until we take a trade on gold. We have option around 114. It's been 114. This has been long time. I mean, it's between 114 for last couple days. So far, so the range we expect between 114 today and 113. So this is for dollar yen, and the option on euro around 11400. We went from 120. Like I said, we went about 183 pips for last 3 days. Now, US market. Right now, it's about, we took short around 164.03. Right now, we are in profit about 250 point. I'm holding this for long term because with coronavirus, we expect at least the market is gonna pull back 10%. So which about 1,600 point. So it was a good short here, and I'm looking to stay short for next couple day or two or week until we hit 10%. Okay, so this is the plan for US market, because I don't know if Germany is very bad situation. All the car company, they closing down. They don't have the microchip. Plus, the Germany is locked down now. So the situation is very bad in Germany. And this is the best country in Europe. So I don't know how they're gonna make it. And a lot of shelf in Germany, they don't have the product to make anything. So the situation is very bad in Germany. And I guess that's why 2 weeks ago, one guy, he's expecting euro dollar to go down to 108. If you remember, one bank, or I guess the Norwegian bank, right now we are 113.50. He's expecting this euro dollar to go to 108 in the next few months. So I guess, so we can put a swing short here. Since the holiday is off now, we're done with the holiday. Maybe we should look for short euro dollar. If we're going to 108, when we are now, it's about 600 pips down. So you have two swing trade right now. The Nasdaq 100 NQ, this is about 10% down for swing, and the euro dollar, it's swing. Now for swing also, I know it's gonna hit 80 on the crude oil. We went from 85 to 67. The Morgan Stanley, they still see target 85 and 90 in next few months. So how is gonna play this? If we have coronavirus and every country locking down, the oil should be go down. But at the same time, China is not closing, US is not closing, and a lot of countries, they're not planning to close because it costs a lot of money. Like Germany, they facing now couple issue. If they close the country, they're gonna save the people from corona. If they open the country, the economic is gonna be in good shape, but the people is gonna get sick. So it's really tough situation. But in oil market, I like it. I maybe buy small around this area, and if we go down another 5 point, I'll buy again. Every 5 point I'll buy, you know, because if the lockdown is gonna put the price lower in euro, and if everything okay, they found a vaccine or anything, all the manufacturers gonna be ordering oil and everything will be fine, so we will hit to 80. So if you don't want to do the adding on oil every 5 point, it's fine, you just skip the oil trade, but this is I'm planning to do. I'll buy some here, buy some every 5 point, like 1, 1, 1, 2. So this is the situation. So oil is short and we have a good signal right now. This is red under these two moving averages, good. The only problem is this radar here. I need to see this red, so in order for me to go short, like this is green is good, the dollar is green, but euro dollar, this mean it tell me if it's this stay like that, it's gonna be sideways. We're not moving only 10 pips, so I'm not interested something like that. We need something to move very quickly. Okay, but I'm not interested in sideways. So OCN, like you see, you have the OC is strong and the yen is weak. You see the price is going higher for like 60-70 pips. Why? Because the OC is strong and the yen is weak. So I'm looking for something move right away in the same direction. You know what I mean? I don't want to hang out for something like that sideways 2 hours, 3 hours. So that's why we have every thing is doing something here in this screen. I'm still waiting. You see, I'm still waiting for the gold trade because this bar here messed up everything. Are we going down? This is, we said we're going down, okay? So we are in downtrend. Then we get a rally, we are in uptrend. So which way we going now? If it's a small bar like this, it's easy to go in and out, but the situation here is different. That's why I'm just waiting a little bit. So get your coffee, your breakfast, eat something until we find a trade.
This comes as Powell says it's maybe time to retire the word transitory, admitting inflation has been more persistent than expected.
The word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation.
UK Health Secretary Sajid Javid says he expects vaccines to be effective against severe disease from the Omicron variant, but tells Sky that only time will tell.
We don't know enough about it yet, but that will be the key thing, is to determine if it is any more dangerous than the current dominant variant.
And crude prices rebounding after a sharp sell-off in Tuesday's session as OPEC and its allies prepare to begin 2 days of talks over their output strategy. Right, very quickly, we've got a big guest waiting in the wings. The Nikkei is up 0.4%. The Hang Seng, which got a bit of a drubbing in the previous session, is up 1%. Elsewhere, mainland Chinese markets moving between 0.2 and 0.36 of 1% high. European futures, we saw them positive before the break. The CAC 40, the best of the triumvirate of big beasts of European trading. The FTSE reclawing 7,100 on the futures. And the US futures, this is where the action is, of course. We are called up. I wouldn't say it's dramatic, but certainly a decent incline on the NASDAQ, less so on the Dow, up 168 points.
The CEO of Russia's second largest lender, VTB, has said potential US sanctions on Russian federal bonds is not a serious threat to the country's financial stability. The state-controlled bank says rising rates will hit margins in 2022, while retail and loan growth are both expected to slow. Andrei Kostin is president and chairman of VTB Bank and joins us now. Andrei, nice to have you back with us on the program. Let's just talk a little bit about the fortunes for the bank then. Your expectation going forward may be that some of the growth is likely to slow.
Yes, for sure. But this year was extremely successful for Russian banking sector. The banking sector will receive the annual profit of around 28 billion, which means a 22% return on equity. And it's mainly because of the growth of all the industries and the prices, commodity prices, oil, gas prices, and the reasonable growth of GDP of around 4.5%. But next year, definitely the growth of banking sector will slow down because the Russian central bank is taking very tough monetary policy. It increased the interest rate, key rate, already 6 times this year from 4.25 to 7.5. So we expect the pace of growth will slow down by approximately 1/3. But we believe that the income and returns, or actually the profit pool, will stay in 22 as it is on the 21.
Yeah, it's interesting. I mean, you're there at Russia Calling, an event I've attended on many occasions in the past. So best of luck with that. But let me ask you, are you anticipating that a lot of those attending will be asking you whether interest rates actually have to rise to 8.5%, as many think they will this December? I know inflation is stubbornly high and there are structural reasons for that in Russia, but 8.5%, that's quite a burden for a lot of businesses to carry.
Well, that was a big debate actually between business and government and central bank yesterday and during our conference. And of course, business is not quite happy about this. But Russian government, the Russian central bank particularly, looks like more monetary than American authorities. And it's a very persistent policy of using the key rate as a major anti-inflation protection. Though we understand also that we also import inflation because the money are too cheap in America, they are too cheap in Europe, and then of course it contributes to the international growth of prices.
Andrei, really good to see you today, sir. We talked a lot about politics over the years, which continually cast a shadow over the relations between Russia and the West. Things are getting worse on that front as we go into looking at a period of consternation surrounding Ukraine. Do you think that's going to be a situation that's going to make things worse rather than better on some of the big issues such as sanctions?
It's very sad, of course, because, our stock market, for example, grew more than 35% since the beginning of this year. But since the end of October, it lost 70% on two actually news. One is, of course, new variant of COVID. And second is the fake news about Russian bad intention towards Ukraine, invading Ukraine, something like this. And of course, it affects the mood of investors. It affects the price of our stocks. But nothing much we can do, bankers. Of course, we very much believe that sooner or later the relationship will become better. We expect there was announcement of the possible new meeting between Mr. Putin and Mr. Biden. So we very much expect that there will be some positive changes. And on the other side, we already used to this, and we have to take it, and all investors take it into account. The geopolitics and virus are playing quite important role today in the economy.
Andrew, you say it's fake news, and let me just question that, and then you obviously get your right to answer as well. But there are reports in the West that there are tens of thousands of Russian troops amassing on the border between Russia and southeast Ukraine. That's fake news, is it, sir?
I already probably mentioned that I'm not working for the Minister of Defense, and I'm not very much following this. But my argument is that whatever movement we are making within the country, it's within our territory. While, for example, we have the NATO ships, including American ships, roaming Black Sea, which is only 20, 30 kilometers away from the Russian border. And actually, in his speech, Putin also yesterday mentioned that we're living in the conditions when for NATO missile can reach our territory in 7 minutes. So we are under much bigger threat, where we believe that, for example, NATO countries or America, from this point of view, and that's mainly a matter of trust. I mean, if we trust more each other, that probably doesn't matter very much. But in the absence of trust, of course, that poses a great threat to Russia.
You've dismissed, Andrei, the threat to fresh sanctions on OFZ bonds. Why is that? I mean, surely that will...
I'm not dismissing, but my argument that, first of all, I think American investors or European investors will lose also if such sanctions are introduced. And secondly, we're not very much dependent on this because, for example, VTB owes more bonds than all American investors, and it's quite attractive, particularly if the key rate continue to rise. We'll be quite happy maybe to invest more. So, and the Russian government, is not borrowing very much because even this year we have a surplus of Russian budget. And next year we expect surplus of about 1%. And Russian sovereign debt is less than 20% of GDP. So from this point of view, we feel quite safe. Our macroeconomics is quite good. So, I mean, any further sanctions on government bonds will not very much affect the Russian financial sector.
Yeah, you were talking...
We borrow much less. A few years ago, our bank's borrowing from the West was about 215 billion. Now it's only 77. I think after the crisis of 2008, we started to borrow much less from the West. So we feel quite comfortable, but we don't want new sanctions. They are no good. They create problem for us. I accept it, but I see no reason why they should more sanction in the near future.
Well, let me ask you, is there going to be progress on the licensing of Nord Stream 2, do you think? Because that's now being drawn into this debate about what further pressure American politicians want to put on Russia at this stage. Do you think that is quite likely?
I think it's a little bit funny situation, but look, there's two sovereign countries, for example, Russia and Germany, and we are building the pipeline to supply Germany or other European countries with the gas, and both sides agree. And then somebody, 6,000-7,000 kilometers away saying, no, you shouldn't build the pipe. You shouldn't do it. You should buy gas from the other sources. It looks ridiculous, in my opinion. So I don't know. I think the Europeans are very much against the sanctions because gas is gas. They need gas. And gas is a very good, ecological, by the way, source of energy. So we very much hope that there'll be enough reason, everybody will understand that there's absolutely, silly situation. So we build it, we should use it, we should supply more gas, and Europe needs Russian gas as we just witnessed during this autumn.
Andre, I just got one on. It's a different subject, but I hope you can give us a comment on this, because you talked about how monetarist the Russian central bank is, perhaps more so than the Americans. And I hear what you're saying as well. Have you got any advice for our Turkish friends and what they're doing on interest rate policy? Because they seem to be slightly less monetarist, certainly than the Russians, and perhaps less so than Jay Powell as well. I asked this, and I know it's an extraordinary question in many ways, because people have looked at the crisis that could well unfold in Turkey and wonder whether it's going to envelop other countries and other parts of the emerging world as well.
Well, next time on holiday in Turkey, I'll give them advice, if you don't mind. But it's a sovereign country, they've got their own policy on this. And I know that's a very volatile situation there, but, it's very difficult for me to make any comments. I think there's always two sides of each process. I mean, the Fed is not very eager to do it. And many Russian industrialists would support this position. But on the other hand, we live in all different environments. We used to live for many years in a double-digit inflation atmosphere, and we don't very much want to come back to this. So for us, we're very specific on targeted inflation at 4%, and I think the central bank is planning to achieve it by the end of next year.
Andre, thank you so much for joining us, and best of luck with the rest of your event, Russia Calling. Andre Kostin, President and Chairman of VTB Bank.
May not be a politician, but that was very diplomatic, I thought.
Well, he was a diplomat, wasn't he? And that's why I think he's always got a line on all of these issues revolving around the relationship between the United States and Russia.
Because a crisis in one emerging market country has historically led to aftershocks and waves of concern about other emerging nations as well. And when one looks at Turkey, one sees a lot of the dynamics that we see elsewhere. And it has previously had ripple effects. At the moment, people looking at Turkey and just saying, well, they're looking at it with bemusement on economic policy, but they're not actually seeing a follow-through for anywhere else in the world. And I think that's probably correct, but we have to road test that assumption, because otherwise it can lead to complacency. I mean, the Turkish lira has lost all of the gains and more that it got off its lows for when the Crown Prince in the UAE arrived in Istanbul and Ankara for a visit there to talk about investment opportunities as well. Now it's gone right back down again, trading circa, there you go, look, 13.36. It's been slightly higher in session as well. But this is a clear and present danger to Turkey. And I just think we have to road test the idea of whether it has ramifications elsewhere. Otherwise, we're not doing our job.
The contagion so far has been very limited. I think we just need to make that point. And when we were sat around this desk, was it about a week ago? And we were then looking at the very rapid declines as the market was getting transparency about how President Erdogan was going to manage the central bank and going to manage the policy rate. And we all looked at it and went, well, he's turning classical economics on its head by arguing that you can ultimately cut interest rates and cool inflation. The challenge, of course, is as you go through the accounts of all these other countries that could be potentially impacted, is just figuring out what their debt exposure is and how mismatched import-export balances are at this point, and whether their borrowings are in currencies other than their domestic currencies.
We were going the same place. I was saying it's not so much about the total stock of debt, is it? But it's about the dollar-denominated debt or the international debt, whether it's in Swiss francs or euros, whatever. That is the key as well, because it's all very well saying this is a battle for economic independence, as indeed the president has said over in Turkey. But the fact of the matter is, if you want economic independence, then don't borrow in dollars.
No. And there is, to a certain extent, the perception of how robust the country's defense of their own currency is likely to be if you are a speculator and if you feel that you have an opportunity here to continue to push on an open door.
We all know that the politicians have got their fingerprints all over central bank policy in every single country in the world. And we can debate whether there is anything such as a truly independent central bank, whether it's the Bank of England, whether it's the Fed, whether it's ECB. But the fact of the matter is, this is the most blatant example of political I was going to say interference, but political dominance of the central banking function on the planet at the moment. I think that's fair to say. Isn't it? I don't think.
And interesting, just to pick up from Andre Kostin's point of view.
Sounds like he's going to Turkey on holiday.
Well, but we know that Ms. Nabiullina has defended very aggressively the independence of the Russian central bank.
Which is no mean feat in Russia. It's done incredibly well.
Insisted to the government that the ruble remains free floating. And obviously that has partly fueled these 8% levels on the inflation
She's done
rate.
incredibly well, hasn't she? I mean, one can argue a lot about what's going on in Russia, about politically, about whatever. But in terms of the central, I've interviewed her, you've interviewed her an awful lot as well.
Yeah,
hung around a long time. Yeah, very impressive character. Coming up on the show. What is coming up? Okay, airlines cancel flights and governments push to roll out boosters faster as scientists race to understand the new Omicron COVID variant.
Okay, guys, I want to show you how bad the situation right now in the market. Look at this chart here. So you cannot do anything like, you see, this is the gold chart, 2 minute, and if you go long, you don't make money. If you go short, you're already in a situation sold out. So the market is not moving anywhere, you know what I mean? So this is basically tough situations. That's why I'm still waiting. From 130 to 240.
Welcome back. UBS has named JP Morgan's Sarah Youngwood as its next group chief financial officer. Youngwood, who has been CFO of the American Lenders Consumer and Community Banking Division, will succeed Kurt Gardner after he announced he will step down. The changes are expected to come into force in May next year. UK Prime Minister Boris Johnson says the government will ramp up delivery of booster shots in response to the new variant. In a televised briefing, Johnson said vaccines will be administered in over 1,500 pharmacy sites and centres around the country, adding that temporary vaccination sites will start, quote, popping up like Christmas trees.
The target that we've set ourselves is to offer a booster to everyone eligible by the end of January. And as with the first jabs, we'll be working through people by age group, going down in 5-year bans, because it's vital that the older and the more clinically vulnerable get that added protection first. We're going to be throwing everything at it in order to ensure that everyone eligible is offered that booster in, as I say, just over 2 months.
US Chief Medical Advisor Dr. Anthony Fauci says it's too early to tell whether the new Omicron variant will lead to severe disease. He said preliminary information from South Africa suggests the variant doesn't result in unusual symptoms. The new strain of the virus has so far not been detected in the US, but officials there, along with President Biden, are urging people to get their vaccines and booster shots. The COVID vaccine developed by BioNTech and Pfizer will likely offer strong protection against the new variant, according to BioNTech's chief executive, Ugur Sahin, who told the Wall Street Journal it was important, quote, not to freak out and let countries speed up the delivery of booster jabs. Sahin added the company is already working on an updated version of its original COVID vaccine.
France's European Affairs Minister Clément Beaune says the country will extend the suspension of flights from certain southern African countries for a week. This after it recorded more than 47,000 new coronavirus cases in the past 24 hours. That's the highest daily increase since April. Germany's next Chancellor, Olaf Scholz, is in favour of mandatory vaccinations for everyone as the country grapples with the latest spike in cases. He expressed his support during a meeting with the outgoing Chancellor, Angela Merkel, and state leaders as they gathered to discuss the latest measures. A decision on whether to make vaccines compulsory could come as early as Thursday, with the mandate coming into force early next year. This as Germany ponders whether to introduce additional measures and restrictions on the unvaccinated after recording over 45,000 new cases in the past 24 hours. I don't know how we move on from this debate, really, about mandatory or being your choice as well, because those who believe in their libertarian stance, for whatever reason it may well be, are going to stick with that. And those who believe it should be mandatory are going to push forward. You have got a rump, now whether it's 10% of the population, 20% of the population, who do not want to get vaccinated. And by forcing them to get vaccinated, I see a lot of civil strife on the back of this one on the streets.
Well, it has to be approved by the Bundestag, so there's going to be very heated debate.
But it's not just Germany, is it?
No, it's not just Germany, but Germany is a laggard on its vaccination program compared to countries like Portugal, Spain, Italy, and Ireland.
Yeah.
I mean, 68.5%. So there are, I guess, questions to be answered about, how comprehensive the protection is against new variants if you have that gap. The irony, of course, is that we are talking about a centre-right government bowing out to be replaced by a centre-left government, which is now talking about introducing compulsory vaccination.
So we have got all of that as a backdrop to the start of equity market trading here in Europe. Lots of data due out. There's more Fed chair testimony that's coming in front of the House this time as opposed to the Senate. Plenty of data on the jobs front as well in the remaining 3 days of the week. And the backdrop is that the futures are trading higher. We'll talk through some individual stocks in about 3 minutes' time.
So this is the situation for from 1:28 until 3 o'clock, 1.5 hours. We're not going anywhere. Now, a lot of people say maybe why you don't take a long here. The problem is I don't have a buy signal. Like in order for me to go long, I need to go long like something like that. When you have a blue here, so the buy pressure will be, but here I don't have this. I don't have it. This is not blue. So as soon as it's gonna get blue or something, we will go long. It's just like you see, it's easy. You go long when you have this together, blue and blue here, you know. But right now, we're still in red, and this is not doing good.
It really has been a bit of a roller coaster ride. If you own a bit of premium before it went to 28% on the, or 28 on the VIX, then you've done quite well out of this, trading your gamma, hopefully. So we had the big downtick day on Friday. The US markets rallied, as did other markets Monday. Yesterday, we saw the fairly swift downtick for the US markets, finishing 650 points lower for the Dow. And today, the rally, maybe. Let's just see what happens next, because it was the testimony from Jay Powell regarding potential swifter tapering, and maybe it's time to retire the transitory word from the Fed chair that actually spooked the US markets and got people thinking about what he was trying to do. Was he using a window of opportunity to say that we could well do this, but if Omicron becomes a more persistent problem, then we can actually not bother doing that at all and leave the stimulus in place. So lots of pontification, certainly within CNBC and elsewhere, about that. Net was the markets fell aggressively. Briefly, the WTI, for instance, on Brent was also down in bear market territory. And again, I'll say it again, it's my theme du jour almost. The fact that, yes, the S&P has done really, really, really very well if you are long in this sell-off, only down just over 3% from its 52-week highs. The fact is that half of companies in the S&P 500 are in correction territory. And half of those, i.e. a quarter in the entire, are in bear market territory. So there's an awful lot of names that have fared incredibly badly in the most recent sell-off from the 52-week highs. Individual sectors today. Well, I would imagine most sectors are in positive territory, but let's take a little look about the negative side of it. Only really real estate and possibly telcos giving up a bit of ground. That aside, we have gains across every individual sector. It really was fascinating looking at the oil and gas complex yesterday. Rollover of futures contracts. We're now looking at Brent for February as opposed to January. But we did see a decent-sized rally. Again, mid-afternoon here, we were down to 64 handle on WTI. Now, it's give or take a 68 handle. And as such, the oil majors are rallying off their lows, with BP trading at 332. London Petroleum, the biggest gainer, up 2.4%. Basic resources and travel and leisure as well, continually seeing travel restrictions either coming in or being elongated as well. And of course, in addition to that, PCR testing increasing, putting off some families and some people from traveling, because quite frankly, the cost of PCRs and the hassle of getting them is stunningly high, isn't it? Let's have a look at European bourses and see whether we are open. Not yet. There you go. The Xetra DAX up 0.9%, as indeed are the other major indices. So moving in lockstep for the FTSE 100, the CAC 40, and the Xetra DAX. Let me just tell you what some of the biggest pieces of data you want to look at for the day ahead. In fact, why don't we have a quick look at oil majors? Are they going to be here, are they? Okay, well, let's have a look then. I'm surprised, but let's have a look. Right. Okay, so the oil majors are over here. Up 2.2% for BP, as I mentioned. Shell trading at 1607, Rosneft over in Russia, 1.9% higher. I was going to tell you about the data today. We've got mortgage applications, ADP employment report, manufacturing PMI, ISM index, and the beige book as well. Plus, we have, as I say, Fed Chair Powell at 10:30 Eastern time in front of the House. So France will extend the suspension of flights from certain South African countries for a week. Meanwhile, Japan Airlines and ANA have suspended new reservations for international flights arriving in Japan until the end of December. The emergence of the new Omicron, actually it's misspelled there, variant also prompted Fitch Ratings to downgrade its global passenger traffic forecast for 2021 and 2022. The agency still expects global air traffic to accelerate in 2022, but remain below pre-pandemic levels. A quick look at the US futures and where they are currently trading. Substantial gains called this morning. The Dow up 200 points, 230 up on the NASDAQ, 44 points higher seen for the S&P. Well, US markets did tumble overnight, as we've been discussing, after the Fed Chair Jerome Powell struck an unexpectedly hawkish tone, saying the central bank would discuss speeding up the pace of tapering in its December meeting in order to tame rising inflation. Steve Leisman has more.
Fed Chair Jay Powell surprising markets by saying he believes the Fed ought to consider easing back more quickly on its stimulus to the U.S. economy. In response to a question on inflation, Powell said in Senate testimony for the first time that the Fed should consider accelerating its taper.
At this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. And I expect that we will discuss that at our upcoming meeting in a couple of weeks.
He made the statement twice during his testimony, suggesting it was a message he meant to convey. In his written testimony, Powell emphasized his concern about inflation and even said another virus wave could create an inflationary problem by making supply bottlenecks worse if workers stay home. Markets now have to puzzle over what an accelerated taper could look like. Roughly every $5 billion increase in the taper amount would bring forward the end of the Fed's $120 billion monthly asset purchases by 1 month. So if it doubled from the current pace of $15 billion to $30 billion, the Fed would end the asset purchases around February instead of May. A faster taper, of course, raises the possibility of quicker rate hikes. JP Morgan calls it a turbo taper and says it will now require a deterioration in the public health situation to hold the Fed back from speeding up. Steve Leisman, CNBC Business News.
The VIX notched its largest monthly surge since February 2020, but despite the heightened market volatility, billionaire hedge fund investor Ray Dalio says it's not safe to keep your money in cash.
What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So, A, stay out of that.
Let's get to Frédéric Carrier, who is the head of investment strategy at RBS Wealth Management. Frédéric, very nice to see you. Look, what do you make of what the Fed chair said yesterday?
Look, first of all, if I may point out, it's RBC Wealth Management. And then as far as Chair Powell's statement yesterday, the economy is indeed strong, and we could see slightly faster tapering than was initially planned. However, we have to keep in mind that monetary conditions are remaining extremely loose, and whatever taper pace we end up with, we believe is going to be a different decision, a different set of criteria when it comes to increasing interest rates. And even if you have two interest rate hikes next year, monetary conditions, again, will remain loose. And it's an environment which is conducive to equities.
Yeah, apologies if I'm mistaken. I thought I did say RBC Wealth Management. I must be honest, Frédéric, but if I didn't say it, then I apologize. Equities remain your asset class of choice, I believe.
Yes, it is. Yes. As you mentioned, the economy is strong, so we have loose monetary conditions. That means that interest rates are not high enough to make borrowers worry about borrowing. Banks are happy to lend. You have inventories which are being rebuilt. You have capital expenditure surging. and of course excess savings, which will prop up the consumer. So in this environment, we think equities should behave well, should give us some modest return. The Fed could spoil the party, of course, but for that we need very tight monetary conditions. And even if we have an interest rate hike at every Fed meeting from mid next year until the end of 2023, the Fed funds rate will still be lower than nominal growth. And in every recession we've seen, it's always been the case that the Fed fund rate exceeds nominal growth. So if there is a recession, if we have to worry about a recession, it will be at the end of 2023. So as far as equities are concerned, it'd be very unusual in this sound economic environment for equities not to perform well over the next 12 to at least 18 months.
Frederic, all it seemed to take earlier in the week was a comment from the CEO of Moderna to have investors rushing to press the sell button. And yet you make the case that you don't think this latest variant changes the bigger picture and the investment approach that you've already set in motion. Why not?
So it's too early to tell, right? Scientists don't really understand this variant. So as fund managers, it's too early for us to change our positions. I think in terms of the impact on the economy, we'd look at a number of things. We would look at mobility data. It's really about the consumer. Is the consumer continuing to consume? Before the lockdown in 2020, mobility data was already suggesting a weakening of the economy by falling 20 and 30% before any strict restrictions came through. So we would also look at supply chains. Supply chains were widely expected to improve mid next year. If that is pushed back, that could make things more difficult. But with respect to equities, we're looking at support levels. Support level of 44.89 is particularly important on the S&P 500. That's about 5% of the year-to-date high. If we break that, it could mean a stronger correction than the usual 5-10% correction, which happens normally in these cycles. If there is a growth scare, a correction of between 10 and 20% could happen. But again, it is too early. People have had working from home, shifting consumption patterns. So it's too early to take action and worry about this too much. But of course, one has to be vigilant.
Frederic, we're gradually losing your line here, so I think we'll wrap up on this. But thank you so much for joining us, Frederic Carrier, Head of Investment Strategy at RBC Wealth Management. Very interesting, I think. Unfortunately, we didn't get to some of the other points that she made in her notes about how in particular, carbon pricing, she thinks, represents an opportunity to buy something that isn't highly correlated to either equities or bonds at this stage.
Fascinating.
And, you know, in the context of us talking about Apple at the wall earlier and the arguments being made around whether Apple represents a defensive opportunity within the equity market, is there a whole new potential sector here, given your, trip up to Glasgow and some of the disappointment? Yeah, exactly. Some of the disappointment there was around that COP meeting, whether ultimately still there is some juice in the carbon and renewable story at this point.
Well, let's hope there is, because it represents a large part of what is deemed by policymakers to be the solvable part of the equation as well. But meanwhile, UBS has named JP Morgan's Sarah Youngwood as its next Group Chief Financial Officer. Youngwood, who has been the CFO of the American Lenders Consumer and Community Banking Division, will succeed Kurt Gardner after he announced he's stepping down. The changes are expected to come into force in May next year. UK house prices rose further in November, according to the latest data by the mortgage lender Nationwide. They posted an uptick of 0.9% compared to 0.5% increase predicted by economists. On an annual basis, house prices in the country rose by 10%. Taylor Whitby up 0.9% on the back of that. Barclay Homes 1.2%. Barrett Developments, 1.4%. You see anything interesting in the property market your way at the moment?
Tight. It's really tight. And
Yeah.
I think it's supply. Supply seems to be the issue still at this stage. You made a terrific point when we were discussing for a lot of these companies as they're putting their outlooks out, what is it that's disappointing the investment community? Is it the fact they're saying that they can't meet demand, or is it the fact that they expect demand to weaken going into next year? And I think the same story is basically playing around in the property market at the moment. Is if we get more supply onto the market early next year and we get a little bit of pressure around the price of money and some of those really attractive mortgage deals taken off the market, will we see, ironically, more supply and prices begin to fall and maybe demand also to slip back?
Supply it's just awful at the moment. Ask any builder out there about land, labor, and materials, and all three are problematic. All three are leading to inflationary impulses in the house price. It's nothing to do with energy costs. It's nothing to do with semiconductor shortages. This is a lot more basic than this. You cannot get hold of the right labor at the right price for love nor money. The land banks are we're a small island. It's very difficult to get the land banks now, or new land banks. And indeed, material costs continue to be stunningly tight.
Yes, but it's not just the UK, is it? I mean, I know there is an inclination to blame everything on Brexit and say that's the reason we've got shortages. But you're seeing them in Germany, you're seeing them in other countries as well at this point, and a lot of that's to do with the supply chain challenges that all countries are facing.
One can look at that. I think we can be honest with ourselves in saying the labour situation is tighter because of Brexit. I think that's probably unarguable, even by the most ardent Brexiteer. But the fact remains is, absolutely, there are other factors involved. Now, elsewhere, November manufacturing data out of Spain has just hit the wires, and it's coming at 57.1 on a PMI basis, as opposed to 57.4 in October. So solidly in expansion territory, albeit with not a huge amount of excitement around those numbers. They're pretty much in line with expectations.
Okay, let's talk about Salesforce. This was the company we were discussing, actually, when we were getting into enterprise software and whether companies are also slowing the pace at which they're digitizing. Salesforce missed fourth quarter guidance. Shares sharply lower after hours. We'll talk some more about it when we come back.
Okay, so you see, you expecting me to go long right here, right? But I didn't go long because we have a sell signal and the market. If we went long here, you see how much we'll be losing a lot of money because this was red and this is red. Now, why you don't go short? Well, the problem is we already oversold here. So I was waiting for a buy signal, maybe easy, because I don't want to sell at the bottom here. And you can see is not enough room to go down. And the market is, if you go short here, the market is going to go against you. So it was a tricky situation. So I was looking for something like that. So if we go down and then we get a blue with blue, I was looking to go long right here, but I didn't see it. So this is what I was looking for, but we didn't get it. So this is basically why we didn't go long, we didn't go short. So it's easy to say, yeah, why you don't take short, but I'm looking for risk management here and it's gonna be too big risk. Like if I go short here, yeah, it's a good setup, but look at this. I mean, how far you can go? It's nothing here. There's no room to go down. Like you see here, when you have this here, you don't want to go short because you're already here at the bottom. And look what happened. The market reversed on you. So I don't want to take it here to take the short. I know the market went down, but it's just be patient for the right setup.
Shares of HP Enterprise sank in extended trading after the software maker's forecasts fell short of expectations. It's now expecting profit of between 42 and 50 cents per share in the quarter ending in January, as against analysts' expectations for 49 cents per share. Frank Holland has more on the story.
Shares of Hewlett-Packard Enterprise falling after an earnings where they reported a miss on revenue but a beat on EPS, 4 cents above estimates. Guidance for Q1 just below estimates. However, the full year guidance was pretty much in line with what the street expected. Its biggest segment, compute, where it gets more than 40% of revenue, that beat estimates. But the other segments that are expected to be the growth drivers for this company as it transitions to an as-a-service company for cloud network infrastructure, et cetera, those segments, those missed estimates, that includes HPC and AI and also intelligent edge, both of them down double digits below what the street expected. CEO Antonio Neri says, the street, however, isn't quite accounting for the revenue stream in intelligent design and HPC and AI, where the company won a $2 billion contract with the U.S. National Security Agency. Neri told me on a phone call, as network as a service continues to grow, we'll have to measure growth in a longer period of time, not just in a quarter, because it's higher margin, very durable. And we want that because it gives us growth in future years. Again, shares of Hewlett-Packard Enterprise falling after hours after a miss on revenue, but a beat on EPS, 4 cents above estimates.
I'll jump in there. I know that Adam was, but that's fascinating. That was a great report there. But so you've got a CEO saying that actually we need to measure differently rather than on a quarterly basis. And it's kind of almost like out of an old playbook where if you underwhelm on a quarterly basis, you say, well, we're measuring this wrong. You need to measure it on a longer term basis because it's a growth business. And we've heard this so many times and complaints from the C-suite when they've missed numbers or underwhelmed on numbers that actually, well, you can't judge our company on a quarterly basis. But why not? That's what I was saying. You have underwhelmed on that basis. Now you can tell the market the story and the market's fully willing or able to look longer term if it wants to. It's not blind to the forward guidance as well. So I kind of don't necessarily buy this. You're looking at the wrong time frame argument that we heard this time around.
No, all businesses have a cycle. Some are short cycle, some are long cycle. Over the course of 12 months, even the long cycle ones may not have completed a full cycle. When you're talking about being able to make comparisons, though, over quarters, it is important that there is no adjustment in the measurement.
Yeah.
Right? So generally, you treat those with a certain amount of caution. Anytime you hear a C-suite executive say, well, you just don't understand our company on a quarter-to-quarter basis, you run for the hills because it usually means that they're going to disappoint over the next few quarters.
Yeah, but I prefer that than the kind of CEOs that we get telling us, you don't understand our company, we actually made money. And I'm like, but under IFRS, you didn't. Oh, yeah, but we made money and we could have if we wanted to. But yeah, you didn't on an IFRS. And we go around in circles because they're telling me they're making money. And I'm telling them under the standard global accounting rules, you're not making money. That's the benchmark I'm looking at. But there you go. I think what they're saying here, and I'm looking deeper into the numbers here as well, the huge potential orders in this company, for instance, in computing and AI, 50% up from a year ago in terms of the demand being very strong in orders going forward. So yes, the present figures underwhelming, but the future figures rather impressive. But the market can make that. The market's not stupid. The market can make that their mind up on that, i.e. today or the jam tomorrow or AI tomorrow.
Oh, absolutely. While we're in that space, let's just talk about Salesforce. That company also disappointed the street. The California-based company turned in better than expected earnings and revenue for the period ending October 31st. Shares, though, dropped more than 6% in after-hours trading after the software giant's fourth quarter earnings guidance came in below expectations.
We have a flash looking at the curve in the United States, and the gap between the 2 and 10-year US Treasury yield has shrunk to 88 basis points. That is the lowest since January of this year. So rather than a steepening at the top end of the curve, because that's not really moving too much, is it, the 148? This is about the sell-off in the short-term 2-year, I would imagine. Again, correct me if I'm wrong. And because, of course, they're talking about less purchasing on a shorter term basis, potentially in the 2-year part of the curve. I mean, we're not seeing any great movement on the 10-year. So I would suggest that this is about concerns about the swifter pace of tapering and what it means for the short end.
Let's just talk about the jobs data that we're looking forward to here. Private sector payrolls in the US are expected to have risen by 515,000 in November, down from 571,000 in the previous month. Non-farm payrolls data is also due this Friday after a stronger than expected reading in October. I know that the expectations are generally high for what this jobs number is going to deliver here. And of course, as we've looked at the claims numbers, they've also been declining in an encouraging way. The one thing I just wanted to throw into this is why then have we seen in the Conference Board consumer confidence data a weakening on expectations around employment and income going forward? And that, to me, look, it's a Conference Board sentiment data series. So, you know, there are lies, damn lies and statistics, and people might argue that they're not always the most reliable indicator of where we're going on numbers like GDP. But they do give you a bit of an insight into sentiment. And when people are confident about the outlook, the numbers are better. And why are they not as confident, given that the employment trends still seem to be very strong, and we've seen companies either lift their minimum pay or indeed offer bonuses to get people to come and join, as we've seen this so-called Great Resignation?
It is an interesting survey because it doesn't tally with the JOLT survey, which is quite frankly telling us that people are still quitting in their droves, that there is a vast amount of jobs available and that hires are elevated. But then you add in the third confusing part of the equation. In fact, there's more than three, but we'll just add one more in here. And that is the participation component of the jobs report that we're going to get on Friday as well will remain stubbornly low. And that points to structural issues still remaining in the US jobs market. So confusing data with the Conference Board and the JOLTS, perhaps saying slightly different things. And you add in the fact that we haven't got those jobs back in terms of participation from before COVID. Yeah. And it does paint a murky old picture.
Well, and the other issue is we started off the program talking about Jay Powell's testimony. And this was a Federal Reserve that was all about employment, we were told. Does this now mean that Jay Powell is satisfied with the levels of employment that we're seeing, that some of those conundrums that you've pointed out there in the data have become less relevant for the way he wants to steer interest rate policy now?
Yeah, good question. We will leave that one there. We'll still be talking about this on Friday, of course, which is when we have the non-farm payroll. But in the meantime, coming up on the show, the UK prepares to ramp up delivery of booster shots as other European countries discuss tighter restrictions and whether to make vaccinations mandatory. We'll have the latest after the break.
Okay, we took short. I will explain why we took short.
Let's take a look at European equities. It looks like they followed Asia into the green, and US futures are trading higher amid
Let
a
me take a
relief rally
screenshot
following another
from the
down
other
day on
computer.
Wall Street. Time to retire transitory? Well, the Fed Chair, Jerome Powell, says that he admits inflation has been more persistent than expected, while striking a hawkish tone on tapering, even in the face of the Omicron variant.
Now the economy is strong, and it's strong, and inflationary pressures are high. So we're looking at going to discuss the possibility of a faster conclusion and wrap up those purchases a little earlier.
Crude prices rebound after a shock sell-off in Tuesday's session as OPEC and its allies prepare to begin 2 days of talks over their output strategy. Plus, the UK Health Secretary, Sajid Javid, says he expects vaccines to be effective against severe disease from the Omicron variant, but tells our sister channel Sky that only time will tell.
We don't know enough about it yet, but that will be the key thing, is to determine if it is any more dangerous than the current dominant variant.
Okay, so this is what's happened. The reason I took short, we have a sell signal here, and when the market tried to rally to hit this trend line, so we took the short here, and that's why we make the 500. Now I cover because we already down here, so there's no more room to go down. Okay, so that's why I explain why I took short. And we did 500. Last trade, I guess, close was 500. So let's see if we can take long now. I hope. It went for 435. The close for 435. Anyway, I have it on the other computer. I don't know why is this not working. Try to get, let me see the whole history. For some reason it's not working in this computer, but it's 435. We got 435. So let's see if we can take long. So I know everybody was looking for long, but I told you the setup wasn't It wasn't long. Yeah, I know everybody want a long here and here, but we didn't get long. That's why. And right now, I don't want to short at the bottom. You see, it's little difficult. Maybe we go long soon if we get a buy signal like this with blue. So this will be easy. Or if we can rally a little bit, we hit the trend line, I will go short. So this is a two scenario. If I get the rally and we hit the trend line and we still red, I'll maybe go short like we did here. And if we get a blue with blue, I'll maybe go long. But I'm waiting for the setup. Now, US market went down 100 points. We went from 16400 to 163. This is about 100 points so far. Each point it's $10, so it's like 1,000. I'm staying short on this. I'm not taking a profit on this. Just be patient. We get very, very good location to short. So stay short. Don't take the money. It's not like the gold. If you want to take the money, if you want to go to sleep or you want to go to work, you can take. But I guess we took a very, very good price right here short. So I took like 3 position. I closed first one. I'm keeping the other 2 running.
I mean, Mr. Erdogan has got a wealth of domestic problems. Is he looking for an international release to try and kind of distract from some of those issues as well? Mr. Erdogan, of course, is very well known for keeping a foot in both camps of both NATO and with his Russian contracts to buy S-400 defense missiles, and at the same time wanted to keep the F-35, which the US was pretty fed up about, to be honest, and obviously withdrew that contract as well. So I'm not entirely sure, A, about the mediation and how the West will feel about this, and B, about some of the other news flow moving the needle forward.
No, I agree with you because, look, I think we're all now capable of understanding at times the information war that is used to confuse and to create false trails.
On both sides.
On both sides. And I think until we actually see anything that looks more meaningful and offers solutions in an international context with all parties at the table, then I'm not quite sure, as you say, how much further this takes us at this point.
Andrei Kostin is not a politician, but he's very, very well connected in the top echelons of Russia. And he said to us on this channel that it is fake news that there is a Russian military buildup on the southeastern border of Ukraine as well. Now, if that is the case, which we challenged and he responded, then where is the crisis? Why would there need to be mediation if there isn't a Russian military buildup, which Mr. Zelensky and others fear will lead to some form of invasion?
Yeah, no, I don't disagree. What else we got here? The Russian Foreign Ministry, just to add to the commentary, we were talking with Andrei Kostin at VTB about sanctions with the United States, and obviously everything we've discussed in the context of Ukraine. There will be some aspect of US involvement or oversight. But the Russian Foreign Ministry says US embassy staff who've been in Moscow for more than 3 years must leave by January 31st. That's the line I have. I don't know a huge lot more about why we're getting that comment at this point, and whether that relates to previous tit-for-tat expulsions that we have seen, of course. But that's a report that's come out now and is being reported by the RIA, or the RIA news agency.
Right.
Should we pick up on the COVID and just put this to one side? Obviously something that you need to just keep a weathered eye on in further programming here on CNBC. Back to COVID. The US Chief Medical Advisor, Dr. Anthony Fauci, says it's too early to tell whether the new Omicron variant will lead to severe disease. He said preliminary information from South Africa suggests the variant doesn't result in unusual symptoms. The new strain of the virus has so far not been detected in the US, but officials there, along with President Biden, are urging people to get their vaccines and booster shots.
The COVID vaccine developed by BioNTech and Pfizer will likely offer strong protection against the new variant, according to BioNTech's chief.
So if you just join us, I don't know why the history, but this is what we did today. Only one trade. I got a screenshot from other computer because it looks like this computer can get the history. So we did one trade so far for 435. And I told you why we took short, because we hit that trend line and we cannot get below, so I took the short, and when we get here I cover my short. Okay, now it's very risky to take a short after you drop all this bar. You want to take short here again. I mean, I know the market is still, but it's very risky. Okay, so let's see if we can get long set up here. I hope this was recorded, because this is unusual situation, so people can learn how we trade in detail. I guess it's still recording, yeah. All right. So the NQ is doing good so far. Now, euro dollar, look what happened. You see, this is euro dollar. The euro started going red, and the dollar. And look, did you see what happened now? It was good timing. If you took it, I was busy on gold trade, so I didn't take it. But this is what I'm talking about. Euro, this is the perfect time. You're not going sideways anymore, because this is start going red and this is green. So euro dollar will be a sell signal. You are trading under the moving average and everything red. This here section red and green. So this is perfect setup, but I missed it because I was watching the gold and the NQ. We also talk about dollar yen 113, 114. We're still hanging. It's the same, so we're looking for 114 or 113. But let's finish the gold if we have another trade on gold, and we will focus on currency market later.
What is 3 months to you and I, Jeffrey? What is 3 months? What is March finish of taper compared with June finish of taper? And the answer seems to be about 650 points on the Dow.
Yes.
Which is extraordinary because we're not talking about a change of strategy necessarily. We're just saying, well, actually, we're going to finish this part of the equation a bit earlier. But I think what people extrapolated, and I think what Mr. Powell has been at pains for people not to extrapolate, is that the end of the taper program equals the start of the rate hiking cycle. Now, that's the inevitable conclusion that people will make, and I understand that. But I think the Fed's communication has been, no, not necessarily. We're going to finish one, then we're going to have a look and see what the conditions are as and when for rate hikes. But I think the market has quite logically said, well, they are related a bit more perhaps than the Federal Reserve wants the market to extrapolate.
Yes. There's also a little bit of an outlier here. Look, Jay Powell has had a very strange month. Let's face it, there was the prospect that Lael Brainard was going to take over at the Fed, and effectively from here on in, Jay Powell's commentary would be viewed through that prism of he's an outgoing Fed chair and not a Fed chair whose jurisdiction is going to be rolled over. Here was an opportunity for him just to restate his credentials and tweak the message a little bit. And we know that he's come in for an awful lot of criticism around the use of the word transitory, given how stubborn some of these inflation and supply chain problems have been. So I think it was an interesting opportunity. Let's wait and see what they ultimately do here if it comes to increasing the pace of taper.
Absolutely. Now, the data by and large has been rather good this morning. The French IHS market November final manufacturing PMI, what a mouthful that is, 55.9 as opposed to 54.6 on the flash figure. So a positive figure from Italy, from France, and an okay figure out of Spain.
Tel Aviv has been named the most expensive city in the world for the first time ever. The Economist Intelligence Unit ranked the city #1 for cost of living, knocking Paris and Singapore into joint second place, followed by Zurich and Hong Kong. Simon Baptiste joins us, global chief economist for the EIU out of Singapore. Simon, let me just ask you, is it good to be known as the most expensive city in the world? In what way is it a nice title to hold?
Well, I think for most people living in Tel Aviv, they would not be very happy to be on the receiving end of the title. But I think it is important to remember that high prices are not necessarily bad. For example, one reason that Singapore ranks so highly is that it's very expensive to own a car here. And one side benefit of that is that we have very low levels of congestion. Of course, that's a policy choice on the part of the government here. Likewise, in Tel Aviv, it's a relatively expensive place to buy petrol and to buy alcohol. And it's become relatively more expensive through the course of this year. But they're prices that are highly influenced by government decisions. So there is part of it that is about policy and not so where high prices might be desirable. But other things like currencies and then local demand, availability of manufactured goods, supply chain shortages, and of course inflation are all playing a big role as well.
Yeah, it's interesting that topping this list, there is a read across to some of those cities that have been cited as the best places for doing business traditionally as well. And that would in part explain why the tightness of land supply, why prices of prime property are so expensive. As you look at the list this time round, there are some notable fallers. And let me just throw, I think, Rome into the mix here, which has come down quite a lot. Can you draw any parallel in the movement of cities with their either improvement or failing when it comes to good places to do business?
There's certainly some connection, but I wouldn't say it's very tight or very direct. Prices can go up or down for different reasons. Now, if a place is a really good spot to do business, then you'd expect more demand for the kinds of goods that business people are looking to buy, and that's what this index is based on. And so the better you are for business, you might expect to be more expensive. One key factor with the cities that have fallen down this year, Rome is a big one, but there are others, including Dubai and Bangkok, where prices actually fell as compared to the last survey. These are all cities, along with Rome, that rely on high levels of visitors. And a lot of the demand in the city, the local demand, is coming from people who are in temporarily either for business or in these cities, tourism being a big one as well. So through the last year, with that source of demand being much, much lower, a lot of services and goods that perhaps otherwise had higher prices because of the bottlenecks or high demands from business travelers and tourists that have relatively lower price elasticities, they're less less respondent to higher prices, has meant that in those places, the extra capacity that has, like a travel has built up, means that some of these goods prices have actually fallen as a result.
Yeah, but by and large, the costs are going up, Simon. So a question for you, a question du jour, is it transitory?
Yeah, so this year did see in our survey the highest level of price increase in the last 5 years, which, given the things we're seeing at the national level with CPIs, is not really a surprise. I expect inflation to remain relatively high until the end of 2022. Of course, now some big question marks with Omicron coming out about how that develops and how that will affect it. But our assumptions at the EIU are on a baseline that we expect, say, 2 more waves like Delta happening through 2022 with some sporadic lockdowns and restrictions. So with that kind of baseline, I think prices are going to stay increasing through to the end of next year. Then I would expect commodity prices to start coming down and some of the supply chain issues to start to loosen up. Personally, I think it's clearly that inflation is not transitory, something that extends for 18 months and will probably go on for another 6-12 months or so, is not a transitory phenomenon. Well, it depends on your time horizon. It's a medium-term issue at a minimum.
Simon, great to have you on. Thanks for joining us. Simon Baptiste, Global Chief Economist at the EIU. We'll round out the PMI series with Germany, the German number coming through at 57.4. The flash was 57.6. So just an easing off the expectation for Germany here, in spite of just about everybody else that we've mentioned coming in a little better. Maybe that has something to do with some of the pressure we've seen on manufacturing in the Chinese economy. We've got to wrap up the program. Thank you for tuning in this morning. Street Signs up right after the break.
Something is not right today because NQ is going down, the gold is going down. So usually when NQ go down, usually the gold going higher. So one of these 2 chart is wrong. They have to catch up later. Because usually they trading opposite. If this is going down, this should go higher. And if this go down, will go higher. But both of them is down. So we'll see which one they will fix later today. Because for last 24 hours, they going together. You see, this is went higher, this is went higher. This is went down, this is down. And this is unusual. So until now, let's see if we're gonna get a buy signal or not. All right.
Good morning, everybody, and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. European equities follow Asia into the green, and U.S. futures trade higher amid a relief rally following another down day on Wall Street. Time to retire transitory, so says Fed Chair Jerome Powell, as he admits inflation has been more persistent than expected, while striking a hawkish tone on tapering, even in the face of the Omicron variant.
Now the economy is strong, and it's strong, and inflationary pressures are high. So we're looking going to discuss the possibility of a faster conclusion and wrap up those purchases a little earlier.
Crude prices rebound after a sharp sell-off in Tuesday's session as OPEC and its allies prepare to begin 2 days of talks over their output strategy. And UK Health Secretary Sajid Javid says he expects vaccines to be effective against severe disease from the Omicron variant, but tells Sky that only time will tell.
We don't know enough about it yet, but that will be the key thing, is to determine if it is any more dangerous than the current dominant variant.
A very warm welcome to the program, everybody. I want to kick off the show with some final PMI data coming out for the Eurozone for the month of November. Just crossing the wires now, the PMI, the manufacturing PMI for the month of November has come in at 58.4. That's up from 58.3 in October. It is a touch light versus the flash estimate of 58.6, but importantly, that is still comfortably above the 50 mark, which of course separates growth from contraction. In terms of the detail, Chris Williamson, the chief business economist at IHS Markit, says a strong headline PMI reading masks just how tough business conditions are for manufacturers at the moment. Although demand remains strong, as witnessed by a further solid improvement in new order inflows, supply chains continue to deteriorate at a worrying rate. That's his comment for the latest manufacturing PMI, which has just come out. So supply chain issues continue to be an issue. Bottlenecks have worsened, but growth has picked up in November versus October. All right, let's take a look at European equity markets and how the session has started. Yesterday was an incredibly volatile session on both sides of the Atlantic. This morning, European equity markets are firmly in recovery mode. Every major region is trading higher this morning. The FTSE 100 up about 1.3%, leading the charge. The CAC 40 over in France up about 0.9%. The German index up more than 1%, as well as the Italian and Spanish markets. The Swiss market lagging a little bit, up just 16 basis points, but overall, we are seeing a rebound in sentiment this morning after yesterday, the Stoxx 600 ended about 0.9% lower. Now, yesterday, there were two dominant themes. One were headlines around Omicron and a lot of back and forth in terms of reassuring and concerning comments. And the other were comments out of the Fed. Fed Chair Jerome Powell struck an unexpectedly hawkish tone in his most recent testimony to the Senate Banking Committee. Powell said the central bank would discuss speeding up the pace of tapering at its December meeting in order to tame rising inflation. His comments come as the Omicron variant continues to spread, but so far not to the United States. Speaking before a Senate panel, Powell said that tapering could wrap up sooner than previously anticipated, opening the door to interest rate hikes soon after.
At this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. And I expect that we will discuss that at our upcoming meeting in a couple of weeks.
Powell also declared it high time to retire the word transitory, a key term the Federal Reserve has used to describe recent price pressures.
The word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
Let's take a look at currencies and how they're holding up this morning. Yesterday, we saw the dollar index drop about 0.5%. But for the month of November, the dollar index ended up nearly 2%. So the dollar has been on a strong run, but that reversed yesterday. Now, this morning, we've got the euro trading on the back foot versus the greenback, currently down about 18 basis points. And so those losses have been accelerating. Earlier on, the euro was actually trading higher versus the dollar to the current level, 113.17. Sterling, meanwhile, also trading slightly weaker versus the dollar, now down about 5 basis points to 132.89. Let's bring in Jordan Rochester, head of FX strategy at Nomura. Jordan, thanks for joining us this morning on the back of another volatile session for financial markets yesterday. Let's kick off with what we heard from Jerome Powell, given how important the Federal Reserve is right now for the outlook. What did you make of his hawkish U-turn yesterday, and how radical a shift is it really based on what we heard yesterday?
Morning, Julia. I think it's a radical shift in terms of central bank thinking overall for global central banks. It's something major central banks such as the ECB will have to take note of, which is Jerome Powell essentially acknowledged that COVID-19 is inflationary. And previously, the hit to demand from mobility restrictions and social restrictions had deemed COVID-19 to be demand destroying and therefore a deflationary pressure. But because of the supply chain issues and because they're not going away, you mentioned the PMIs this morning in Europe, essentially saying supply chains have gotten worse, if anything. It's a key determination of the central bank to change their view away from this transitory nature of inflation towards actually looking at COVID-19 and saying, hang on, this might leave a permanent mark on inflation. We're not going to see 5-6% inflation next year, but it could be above the Fed's 2% target. And that's something they have to react to. What does that mean for markets? Well, in the morning yesterday, you saw the dollar was quite broadly weaker, and the markets are looking to buy risk assets and also fade positioning. So long dollars is a crowded trade in the FX market amongst the macro community who are still in FX trades. And amongst those trades, euro-dollar has done very well. So it makes sense to unwind that short euro-dollar position given the risk-off fears we had with Omicron. But it seems weird for me for euro to strengthen in an environment where the Fed is looking to accelerate tapering.
Jordan, I want to pick you up on the comment you just made about the macro community that is still in big FX trade. How is positioning at the moment?
We use a few indicators. We use futures, we use SDR data, which captures option flows. Look, essentially futures are saying that euro-dollar positioning is short, so long dollars is the consensus trade, but it's not big. And because of the sell-offs we had in front-end rates, a lot of hedge funds are just not involved in the trade as they usually would be because they're down 10 to 20% on the year. And we've got less than 1 month now until year end. A lot of people are nursing those losses and trying to avoid getting caught up in whippy markets. And as you're seeing in the dollar right now, it's pretty choppy.
Similar to what we're seeing in equity markets as well, with a lot of hedge funds just wanting to lock in what gains they have made at this stage, given the volatility. Jordan, in terms of the Fed, does a faster taper necessarily mean sooner than anticipated rate hikes? The Fed chair has been keen to dissociate the rate hiking cycle from the end of bond purchases. But what should we read into the future path of rates on the back of these comments around tapering yesterday?
For economists, what you just described is probably the narrative you'll hear from all of the sell side notes. So essentially, the Fed tapering faster does not necessarily mean they raise rates faster. For markets, that's just not how they will work. A faster taper means higher chances of an earlier rate hike. So I'm looking at the May pricing. So the meeting in May has around 18 basis points priced in before the Omicron variant came in. We're a bit shy of that right now. I think it's moving quite a lot this morning, but let's say we're around 15 basis points. So we still haven't recovered yet the Omicron sell-off from Friday. And so maybe we see a bit more priced in for the Fed on the back of Powell, and that could support the dollar. But let's just walk through the timeline. Inflation peaks in February. We get that data in March, and it's going to be really hard for inflation to keep rising from February onwards because energy prices eventually will cool down, especially as we move into spring. So the Fed will be looking to raise rates as inflation is falling. The question is, how far and how fast will it fall?
Jordan, let's turn to the euro a little bit more explicitly. Yesterday, it fell a little bit into the background given the headlines around Omicron and the Fed, but we had a pretty significant inflation print in the euro area, the highest level since the creation of the single currency. Inflation came in at 4.9% versus 4.5% expected for the bloc. Core inflation also surpassed expectations. What does all this mean for the ECB?
This is the trade for next year, Julia. So right here, right now, the ECB will be looking at German hospitalizations rising, even French and Italian cases going up. So it's really unlikely that the ECB is going to be hawkish at the December meeting, given this new variant. But Q1, Q2 will get better data on the labor market. This inflation data you just pointed out, it's all about energy is what economists will tell you, but I'm looking under the hood and I'm seeing non-energy related industrial products going up. There's going to be second round effects. And the story you have in the US right now with used car prices, it's something that you hear about a lot, but you don't talk in a European context. I'm also looking at the data and seeing European car inflation, purchases of cars, is also going through the roof, the highest contribution to the series. Now, it's only 4% of the basket, but this is going to be something that carries on throughout the rest of next year, is surprises in European inflation. And I think the market will be pricing in the idea of rate hikes in 2023. So next year, the trade will be euro-dollar finds some ground, and we'll be talking about the ECB ending its negative rates.
And Jordan, what about the UK? I mean, here in the UK, we are also seeing COVID cases remain high. Of course, the approach has been slightly different to parts of Europe. And the long-held view is that the UK won't go back into the strict lockdowns that we faced in earlier 2021 and in 2020. What is your take on the outlook for the UK in the face of the Omicron variant and how this will affect the GBP USD trade going forward?
So if I tell you about the labour market data, we've got a very hot labour market. So the Bank of England's going to look to raise rates in December. We're not as hawkish on the Bank of England than the market. So we do expect them to raise rates in December, February, and May. The second half of next year, just one rate hike, not two. The market before the Omicron variant was pricing in a rate hike every quarter, and December this year as well, that 15 basis points. So for me, the risk reward was that maybe we'll get some bad news. Maybe the China slowdown will weigh on sterling, and that will lead to cable going lower. So we're short cable, and also I should mention we're short euro dollar as well. When it comes to the UK, though, the labour market data is holding up pretty well. When it comes to the virus, I'm not too concerned about the UK compared to Europe. Thanks to reopening the economy, high levels of contacts has led to a higher level of naturally gained immunity against the previous variant of Delta. And also the booster program. The vaccine booster program in the UK is leagues ahead of its peers. So around 22% or higher of the UK has had a third shot of a vaccine, where in Europe, it's around 9%. So it's quite a significant difference. And that's why we're going to see the situation with Germany play out in Italy and France, but not really play out in the UK. Hospitalizations in the UK are actually slowing.
So short cable, I'm putting it all together. Jordan, let's just wrap up with EM currencies. I've spoken to a few investors who've taken the view that this latest emergence, the emergence of this latest variant, Omicron, has really highlighted the risks of leaving developing markets behind when it comes to vaccinations, suggesting that moving forward, developed markets will take more action and play more of a role to getting vaccines to developing countries. I wonder what your take is on how this latest episode, this latest phase of the pandemic will affect EM moving forward. And do you think there is a trade to be made in some of these emerging market currencies?
I think there is. So in terms of the trades to do, it's looking at countries which are more exposed to tourism. So just a few weeks ago, Thailand opened its borders to travelers. And now we're going to start to see the Omicron variant pop up in different countries over the next coming weeks and months. And you might see the same reaction from governments to this South Africa situation. So being put on the UK's red list, for example. So those countries that are exposed to tourism, such as Thailand, they're going to suffer the most if the world essentially goes back to what we saw last winter with quite firm travel restrictions. And then when it comes to the vaccine story, the good news is the fears around this variant have led to an acceleration of vaccinations in South Africa, for example. The problem with South Africa is not supply of the vaccine anymore, it's vaccine hesitation. So that's something that they're looking to address. There's also talks from Ramaphosa on making vaccines mandatory. So that's something that could take place. And the good news just broadly is that Moderna and Pfizer, last year the problem was supply issues. Now, after a year and a half of this, hopefully that's not as much of a problem for emerging markets, and therefore they can get hold of the better vaccines too.
Jordan, we'll leave it there. Thank you for the wide-ranging conversation. Jordan Rochester, head of FX strategy at Nomura. As a reminder, you can follow us on Twitter at StreetSignsCNBC. You can also tweet me directly if you want to get involved in the conversation. I'm at CNBC Juliana. Coming up on the show, Chinese manufacturing takes a hit as demand slows and prices pop. We'll discuss next.
I guess either the Nasdaq is wrong or the gold chart is wrong, because they never go together. Today is the first time they go together. They go higher together and they go down together, and they're supposed to be opposite. One should go long and one should go the other side, but today for somehow. So I guess I'm not doing any another trade on gold for now until we figure out who's wrong. The chart is Nasdaq 100 wrong or the NQ is wrong. You know, the gold is wrong. Somebody is wrong, you know, today, and have to be corrected sooner or later, maybe in US session. So we will just take the 435 for today and wait and see better opportunity tomorrow or something, because I'm not comfortable to take a trade right now. All right, talk to you later, guys. Good luck, and I will be on the chat room if you have any question. Take care.